The founder, Colin Huang, also took a bit of a hit, as Yvonne was pointing out earlier on. Before the drop in the stock, he was effectively a gold medalist on the rich list, and now he's barely made bronze. He's now number 4, as you can see on your screens, just ahead of that's Jack Ma. And okay, I'm wearing my glasses, but clearly I'm not. Zhong Shanshan is number 1. Ma Huateng with Tencent, of course, and Zhang Yiming is number 3. Number 4, of course, is Colin Huang, who took a big beating overnight in terms of net worth.
Yep, tumbling by $14 billion or so, the biggest one-day loss ever. Let's bring in John Woods, Asia CIO at Lombard Odier. Tell us a little bit more about the whole China story. It seems like there's still a lot of questions on why foreign investors should come back into this market. And I think this is a clear example of why not, maybe.
Well, I suspect that the low-hanging fruit, the easy money, is clearly a thing of the past now. The macro backdrop to a positive or supportive outlook for corporate revenues is clearly under pressure, as we've seen just in the last few days or so. I would hope, actually, that accelerated monetary easing will provide a little bit of inflation for these margins, these corporate margins, which clearly are under pressure, clearly being subject to compression, and actually a little bit of inflation, I think, will take the pressure off that. But overwhelmingly, I think now this investment story is shifting to a stock pickers market. There are some 5,500 listed companies in China, and the days of purchasing a simple sector-based or index-based ETF clearly are gone. We now have to roll up our sleeves and start digging into the equivalents of their Ks and Qs to look for value. And I'm pretty sure that in this large universe of names, there will be as many diamonds as there are dogs, if you don't mind me my inelegant phrase. But clearly, this is a bottom-up stock pickers market. I think there's value, but it's going to be hard or harder to find.
That reality might also mean that the institutional money, the pension money that we were waiting to come back in, the incremental buyer, do they remain on the sidelines while it remains just a tactical trade, while it remains a stock picker's market, in your view?
A stock picker's market, David, as well you know, is both risky and expensive. It costs a lot of money to hire a large cohort of single stock equity analysts to identify value. And of course, then when you put more eggs in a single basket, maybe 3, 4, 5, 6 stocks that you expect to outperform, the risks are substantially higher than an ETF, which essentially balances and spreads your risk over a wide number of names. And you've seen the flows as well as I have. The institutional money, the foreign money, is very much on the sidelines right now. And I think this is largely driven, as we heard from your analyst previously, by policy risk. We just simply do not know what possible policy is likely to be announced, what it will contain, who it will say, and the impact subsequently on particular sectors and particular stocks. So this is something I think which is really keeping investors on the sideline for the time being.
In the same way that inflation in the U.S. was a good gauge of margins, and when we had inflation in the U.S., the market actually did quite well. Do you think that's a good leading indicator for Chinese equity markets? If and when inflation comes back, that's the time to get back in?
I mean, I guess it's a tailwind. It's certainly a tailwind if we start to see a little bit more consumption or inflation driven by consumption, retail spending, supporting corporate revenues and ultimately earnings, and clearly that is a positive thing. But the backdrop around particularly the property sector is overwhelming right now, and until we get some policy support from government relating to monetary easing and or additional further meaningful stimulus towards the property sector, I think the equity markets remain range bound.